Let's stay with the government's changes to taxation arrangements. This time for discretionary testamentary trusts. The government will exempt income from the trusts from minimum tax, provided they're established for genuine testamentary purposes. ABC News business editor Michael Janda takes us through what these trusts are and how people will be impacted.
A testamentary trust is a trust created by a will, and so this is when someone dies and they want to leave their assets, they're doing it via a trust, so that there's a trustee that sort of make sure their wishes are followed in the distribution of those assets. Now, most of these are fixed trusts. That's the normal testamentary trust, which means the trustee has no discretion about who gets what. That's all outlined in the will. So the discretionary element, which is a very small number of trusts, about 10,000 I think is the estimate of how many of these currently exist, is a trust where the trustee actually has some discretion, can make some decisions about how much different beneficiaries get. So they can't determine who gets the money, but they can make some decisions within the bounds of the will about who gets how much and when. And the reason that discretionary trusts have raised tax concerns is that, of course, you can choose as the trustee to give more of the income to people who otherwise don't have income, such as people who are not working, who get the tax-free threshold and therefore don't pay tax or pay less tax on some of that income.
And who usually uses this type of trust?
Well, they're expensive to set up and maintain. This is done through lawyers, and you also have to file annual tax returns once these trusts kick in. So you only do it if you have a lot of assets. This is not the kind of trust system that someone, with your normal middle class person is going to set up. A lot of family businesses are passed down through larger family businesses we're talking about here are passed down through these kind of trusts. So a recent example I've seen is D'Arenberg Wines was featured in the Financial Review. That company is actually held within a discretionary family trust that was set up on the death of the founder to try and keep the business within the family and to protect the assets, because aside from the potential to minimise tax, the other reason a lot of people like having their assets in trusts is it protects them from other legal claims. So if there's a legal claim against one of the individuals who benefits from the trust, the claimant can't access the trust assets in order to fulfil that claim. If, for instance, there's a family law dispute, a divorce, a creditor claim against one of the individuals involved in, say, a company such as a family business, that they won't be able to touch those assets held within the trust.
So what was the government proposing and how has that now changed?
So the government in the budget was proposing a blanket 30% minimum tax on discretionary trusts. That is, those trusts where the trustee can split the income and potentially use it to minimise the overall tax paid on that income by giving more of the income to lower taxable income earners, people who maybe have super income that's more lightly taxed, or people who are not earning money, maybe university students and so on, who can benefit from that and pay less tax overall. So originally that was to apply to all discretionary trusts. The change that the government has announced today is that these discretionary testamentary trusts, that is, ones set up in a will be carved out from that, so they won't face this minimum tax, unlike the rest of the discretionary trusts which will.